And by the way, with regards to transactions, you ain't seen nothing yet. The transaction that was recently announced between Wheaton and BHP is the shape of the future. It's important to note when you look at the royalty and streaming companies that the Bay Street knock against them, which is that their big transactions are a thing of the past. One of the things that plagues both the royalty and streaming companies and the big multinational miners is what we call the net present value paradox. I think what changes the game on Royal Gold isn't that. Well, I think 4 Mile does, but I think 4 Mile changes it over 5 years. What changes the game on Royal Gold, the knock that the market has against Royal Gold, is revenue concentration. Revenue concentration on one asset. One of the reasons why I think they had to do this. It was probably time for Clive Johnson to retire. However, I've known Clive for 40 years, and I took a certain comfort in knowing how Clive operated from watching him up close and personal for 40 years. And so, although on balance it was probably a good thing that Clive decided to move on, for me personally and my access to information, it was a bad thing. I didn't myself think that the financials in terms of fiscal 2025 were bad. I thought they were actually quite good. But the guidance, as you suggest, was lousy. And the observation that you made with regards to the timeline to establishing nameplate capacity at Goose is uncertain at best. This reminds me of nothing so much as the challenge that we went through with Equinox, at Hard Rock in Ontario, well over budget, well over time. And after they attained economic completion, a long time before they reached nameplate capacity. If B2 is able to attain nameplate capacity, as Equinox was able to do, I think that you're going to see the stock re-rate. But you'll notice that I began that sentence with the word if. It is less certain than it was before the reporting season. I don't know internally if Clive Johnson decided that it was time for him to move on, that the challenges that were required in completing this mine and building the next one rightly belonged with a younger person. One can't blame him for that. Or if influential shareholders decided that Clive should be thanked and excused. I don't know what the answer to that is. I think over the 5-year time frame, it's probably a good thing for B2. For me, because Clive is predictable, because I've invested with him since 1987, it was a bad thing. And by the way, with regards to transactions, you ain't seen nothing yet. The transaction that was recently announced between Wheaton and BHP is the shape of the future. It's important to note when you look at the royalty and streaming companies that the Bay Street knock against them, which is that their big transactions are a thing of the past, is exactly wrong. The big transactions will come about as a consequence of the fact that the global copper industry requires $250 billion in capital expenditures over the next 10 years, which is $100 billion more than they have. And they're going to get half of it by isolating the gold and silver revenue from their copper porphyries and selling them to the companies that you've mentioned. In other words, the big transactions are in front of them. Bay Street says, may or may not be true, that one of the reasons that Royal Gold did the transaction that they did, the Sandstorm transaction, was because of a dearth of opportunities in the past. If that's true, that's about to come to a screeching halt, an absolutely screeching halt. It's important for your listeners to note that revenue in a big copper porphyry gets valued at between 5 and 7 times cash flow at a copper multiple. If you take that same revenue and you strip it out and you put it in a stream without having to make sustaining capital investments or anything else or operating costs, that same revenue sells at 15 or 17 or even 20 times revenue. That means that very, very large mining companies can do transactions with the streamers that are accretive both to themselves and to the streamers in large amounts. And the transaction that we saw a week ago is really, truly the tip of the iceberg.
The royalty and streaming sector is poised for massive growth. Companies like Franco-Nevada, Royal Gold, and Wheaton Precious Metals have collectively executed billions in transactions, driven by the global copper industry's need for $250 billion in capital over the next decade. Royalties allow mining companies to isolate gold and silver revenue, creating high-margin, low-risk income streams. These deals can be extraordinarily accretive, benefiting both miners and royalty companies. Rick emphasizes that the sector's biggest opportunities are still ahead, with long-term cash flows offering stability and leverage for strategic acquisitions.
One of the things that plagues both the royalty and streaming companies and the big multinational miners is what we call the net present value paradox. When you value these natural resource income streams, you take your best estimate of their future cash flows and you discount them back at whatever the appropriate rate is. They use 5, which is stupidly cheap in the gold business. They use 10 in the oil and gas business, which probably is a bit high. But at any rate, the point of all that is that when you discount those future revenues back on a net present value basis, most of the revenue that occurs off after year 10 is valueless from a net present value calculation. But take it from a 73-year-old, it comes in handy. And when we analyze these long revenue tails, we don't put a residual value on the tail when you do a net present value calculation. And that's really important because that tail has value. If you have a 30 or 40-year mine life and you've used up the PV10, which is to say after 10 years, you reset the PV10 clock back and it's undiminished, which means you run the same thing again and you're not charged for that. The second thing is that most mining companies in the world put a very large deposit into production when they can, which is to say they don't drill it out. They drill enough of it so that they can recoup the capital that they've expended and get a reasonably decent return on capital employed. When you look at a feasibility study, you'll see something called the payback period. In the gold business, the payback period is supposed to be less than 3 years. In the copper period, the payback period is supposed to be less than 5 years. The point of all that is that in almost every occasion with a tier 1 deposit, more than half of the reserves and resources that the mine will ultimately produce haven't been established at the point in time when the mine comes into production, or importantly, when the royalty or stream has been sold. A wonderful case of that is Franco-Nevada, which has been enjoying royalty revenues from the Northern Nevada operations since 1982. They have more reserves and resources on the books in Northern Nevada than they did when they bought the royalty in 1982, which is to say they've produced the damn thing for 40-something years, and they have more gold in place now than when they bought it. Those are just a couple of the unsung benefits of the royalty and streaming space.
Mining valuation often underestimates long-term potential. Traditional net present value, NPV models, discount revenues beyond 10 years, ignoring decades-long production tails that remain profitable. Royalty companies benefit from these undervalued streams, as mines often expand over time, increasing metal output without proportional cost increases. Franco-Nevada's Northern Nevada royalties illustrate this. After 40 years of production, reserves remain larger than at acquisition. Investors in royalty companies enjoy growing cash flows with minimal operational risk. Strategic analysis of long-lived assets, production expansion, and commodity price trends reveals why these companies consistently outperform expectations.
I think what changes the game on Royal Gold isn't that. Well, I think 4 Mile does, but I think 4 Mile changes it over 5 years. What changes the game on Royal Gold, the knock that the market has against Royal Gold, is revenue concentration. Revenue concentration on one asset. One of the reasons why I think they had to do the Sandstorm transaction was to begin to diversify their revenue sources. But precisely the circumstance that we talked about at the beginning of this interview, which is to say the enormous amount of new streaming deals that need to be done, means that Royal Gold will take care of that problem by itself, organically. simply by growing revenues from a bunch of different assets. People say, well, Royal Gold and Osisko royalty are nowhere near, nor Triple Flag, nowhere near the size of Wheaton or Franco. How will they compete? They won't have to compete. Wheaton just did a $4.5 billion transaction. They've got $1.5 billion in credit left. There is going to be $4 or $5 billion a year in transactions, as far as the eye can see. These guys are going to have to syndicate the deals, which is to say, Franco will originate them, Wheaton will originate them, investment banks will originate them, and there will be plenty left over for Triple Flag and Osisko. There is going to be, let's just say, at least as much product as there is capacity for the foreseeable future, and that benefits all of them. Where Franco and Wheaton will have an advantage, a continuing advantage, over the second-tier companies, over the Triple Flags, the Osiskos, the ORs, and the Royal Golds, is cost of capital. And in a capital-intensive business, that's important. I would expect that, given the stability and duration of the cash flows enjoyed by Wheaton, that if they wanted to, they could do a 30-year bond at 3% if they added a little tiny bit of the silver warrant. If you are writing a silver stream with a 7% yield and silver upside, and you're financing it at 3% by giving up a tenth of that silver upside, the arbitrage between the 3 that you wrote and the 7 that you received, if you think about the return on equity, not return on capital employed, is extraordinary. So one needs to remember that these guys, relative to any other peers, have a permanently lower cost of capital. What I do is every single investment I make, I write a memo to myself about why I made it. And I reread that notebook with my current positions every quarter. It's important that if the reasons that you own an investment are no longer true, that you sell the investment. At age 73, realistically, most of the goals I had, I've achieved. So, and also in terms of the way I invest, I mean, could I tweak it? Do I need to learn, as an example, in exploration analysis, to identify more coincidence anomalies through artificial intelligence? The answer to that is yes. But most of my life goals with regards to reputation, customer count, net worth, all that kind of stuff, at 73, it looks very different than it might at 33. But the process that you describe with regards to writing stuff down, every single day I make an investment. I write myself a 1.5 or 2-page investment memo, and every 90 days I read it. And every time I'm out of line on something, I do take action.
Nevada is central to royalty strategy. Royal Gold and Franco-Nevada hold significant royalty portfolios across the state, including Barrick's 4 Mile project. New investments, like Franco-Nevada's $250 million deal with i-80 Gold, expand royalty stakes over time. These arrangements ensure predictable production and revenue growth. The U.S. offers lower capital costs and logistical advantages compared to Mali or Pakistan, making Nevada royalties especially valuable. Despite revenue concentration concerns, ongoing deals diversify income streams and strengthen balance sheets. Long-term planning and strategic acquisitions allow these royalty companies to maintain a competitive edge while reducing risks associated with international operations.
Very recently, I know I did the right thing, by the way, because the market hated it. Very recently, I sold 80% of my physical silver. I did that not because I didn't think that silver could continue to go up. I did it because when I read my investment memo on silver, I very clearly consigned it to the speculative part of my portfolio. I didn't consider it to be an investment asset or a savings asset. I considered it to be a speculation. And the speculation was predicated on the fact that silver was hated, selling for $20 an ounce. And I theorized, at the time I wrote the memo, that if the hatred dissipated, And if the generalist investor began to come into the precious metal space, which is usually the condition precedent for silver outrunning gold, that the silver price could easily go to 50 or above. Well, that happened. That means that the reason that I bought my speculation occurred. And when your speculative positions mature, I believe you need to turn them into investments or into cash. So I did a thought exercise with my silver, which is an important thing to do, always dangerous, but an important thing to do. And I looked at various other speculations that could replace silver in the speculative part of my portfolio. And interestingly, one of the places that I settled on was silver stocks. I managed to get out of my silver mercifully through procrastination in the mid-70s, as opposed to my 50 target. And of course, it kept going to 100 or whatever it went to before it retraced. But I theorized that at $75, silver didn't have to go up anymore, although it might. So if you assume for a second that silver traded sideways for a year at $75, by definition, I didn't make any more money if it traded sideways, right? But the net present value calculations and the earning forecast of the big silver producers were done at a consensus $45 silver. So if you apply a $75 numerator on a $45 consensus, over the course of a year, those silver stocks, even at $75 silver, could be up 40 or 50%. That was attractive to me. Arithmetically, not narratively, there was also some downside cover. If the silver price fell from $75 to $50, the earnings assessment and the net present value calculation done at $45, I'm not talking about the narrative, by the way, but on a net present value basis, I was covered on the downside, I was covered on the flat side, and if silver continued to go up, the silver stocks would go up too. So it seemed to me that for part of the proceeds of selling the silver, a better speculation than the silver itself was the silver stocks.
Rick Rule emphasizes disciplined investment in precious metals and energy. Recently, he sold 80% of his physical silver, reallocating capital to high-quality silver stocks, optimizing upside potential while mitigating downside risk. In oil and gas, evaluating Tier 1 reserves requires understanding volumetric replacement, infrastructure, and pricing anomalies. Companies like Devon Energy have benefited from rising U.S. natural gas prices after long periods of low pricing. Using metrics like the recycle ratio, investors can assess operational efficiency and long-term returns. Rule's approach combines rigorous data analysis, historical perspective, and strategic speculation, allowing him to navigate market volatility and political risk effectively.
I think with regards to Hecla and Coeur, that you have a circumstance where the capital allocation history of those companies is very poor. First Majestic is not so clear that it was very poor. They bought mines that other people thought were at the end of their useful life, but they had been stripped for cash. And First Majestic put the cash and the love into them, San Dimas in particular, and returned them. They did absolutely positively break their pick so far on Jarrett. There's no doubt about that. I do not myself own Hecla or Coeur. I think they're very different companies than they were 3 years ago. Some of the management teams have been thanked and excused. I mean, I had a sense when Coeur moved their headquarters from Coeur d'Alene, where their operations are and where they were named after, to Chicago, where their chairman lived. It told me a lot about who they cared about at that point in time. It wasn't me. It was then. And other parts of the silver industry have been problematic too. If you're going to be a silver investor, by definition, you have to be in Mexico, because that's where the silver gets produced, or you have to be in Peru. In other words, if you're going to have a silver-centric portfolio, and you provide too strict a political risk overview or overlay, you're out of the silver business. So if you think you're going to be a silver investor without owning Peñoles or Fresnillo, or if you think you're going to be a silver investor without owning Buenaventura, you're wrong. You're not. You have to have the courage to take the political risk to get involved in the best silver production on the planet. You have to do that. If you can't do it, then find another sector for yourself.
Investing successfully in resources requires more than market observation. It demands diligence, research, and mentorship. Rule highlights the value of writing detailed investment memos, revisiting them quarterly, and objectively evaluating positions. Conferences like his Boca Raton Symposium offer insights unavailable online, connecting investors with decades of expertise and real-world strategies. Access to independent research, exposure to high-caliber networks, and disciplined portfolio management provide a competitive edge. Ultimately, successful investing blends patience, analytical rigor, and selective risk-taking in sectors like precious metals and energy, allowing investors to exploit undervalued opportunities and navigate cycles of volatility with confidence.
It's very useful for an independent analyst like yourself, first of all, to listen to the quarterly calls, which you probably do, but then go to NAPE and talk to their competitors. I think it's arguable that one of the reasons that Exxon bought Pioneer, or that Devon and Coterra are proposing to merge, is because they have interfingering leaseholds in the Permian. And if you have interfingering leaseholds, it means what was a tier 2 location becomes a tier 1 location, because you can drill a 3-mile lateral as opposed to a 1-mile lateral. The answer to the question, when you say how you can do it, the true answer is, in terms of wanting to get it exactly, you can't. You're trying to know the unknowable. There's too much. There's too much data. When I look at the API data, American Petroleum Institute, for those of your listeners who haven't spent as much time in the grease business as you and I, the API suggests that the industry consensus is that the industry itself, at $60 WTI, has drilled 75% of their tier 1 locations in the Permian. So when somebody suggests to you, if they've been an active driller in the Permian, that they have substantially more than 25% of their locations in remaining inventory, you need to ask yourself some questions. When I had the good fortune on the Exxon quarterly call, after they had talked about the Pioneer acquisition, they specifically said that Pioneer had an above industry average inventory of undrilled locations, but in particular, the interfingered locations that they had meant that marginal locations on either side of the property boundary became tier 1 locations as a consequence of, in effect, unitizing a horizon. And my suspicion is that the Devon amalgamation with Coterra is partly about that. Of course, it's partly, too, about simple heft, about the fact that larger companies have higher trading liquidity, higher share prices, more index buying, and hence lower cost of capital.